Okay, well, I think we'll start. We're having people come in as we sort of drip feeding as we come in. So we've got quite a few registered, and it's great to see so many faces online for our second edition of Minds and Money 5 at 5. So firstly, a big warm welcome to everybody who's back for the second week, and also the people coming back or coming for the first time. We're excited to launch this. Last week we talked about why we're doing it, to support the mining investment community. Next week we've just secured our first event in London. This will be a global event with distribution around the world. So we will be distributing this session to people all over the world. So we've just secured our two mining companies for next week, which is Adriatic Metals, which is an Aussie doing well in Bosnia and Herzegovina. And we've got a company called Cornish Lithium, who are quite an interesting story next week as well. I was actually born in Cornwall, so it's a story close to my heart. I know Cornish and lithium never really existed in the vocabulary when I was growing up. So got two interesting projects next week. We'll also be running some virtual events. So you're going to have to small plug for this, small promotion, but we've got two events that will be coming up in June, which will be our event, a Minds and Money virtual event in London, and also an event in APAC as well. So there'll be two events, so keep your eyes open for those. In regards to housekeeping, or what I might call like digital housekeeping, the main thing really is to use the functionality well. So in the bottom, manage participants. If you go into there and you want to ask a question, there's the hand raising button. Just please press that, and we can then unmute you at the time. There will be times to ask questions, so our hosts will be pretty nimble in taking questions as we go. So after the couple of company presentations, and after the main presenter presents, there's also a chat room as well, which you can access those conversations as well. So if you want to ask a question, we can do that. I said last week, if you get any problems with your Zoom, please turn it on and off. I quoted it as saying it's a 1980s solution, in which one of our group chose to message me and say, actually, the first computer, and I'm having to read this, was invented in 1822 by Charles Babbage. I'm not sure what use that was, but I found it quite interesting that someone came back with that. Finally, the last part is to introduce our host, a charismatic figure, well respected in the industry, who will do a great job this week. So he's a stockbroker, equity partner at Baillieu Holst. He's the chairman of the well-respected Melbourne Mining Club that now has a global reach, and has been a tremendous supporter of our event IMARC, which is now will be in its 7th year. So over to a more accomplished presenter than myself, certainly. Richard Morrow, over to you.
Mike, that's incredibly generous of you, and thank you for that. And look, thanks also to Minds and Money for putting together this 5 at 5 format. It's just like the cutting edge. I can see so many familiar faces. They're right staring back at me, and it's great. I won't take the liberty of having a drink. I'm silly enough without any alcohol in me. So I'd rather just press ahead and let's get as much out of this as we can, because we've got 4 fantastic guests here, and I'm looking forward to hearing each of them. I was absolutely chuffed to be invited by Anita and the team to host today, and I hope there's more than a few Melbourne Mining Club members switched on here, because it is a great panel. So let's introduce them. May I introduce firstly Sophie Spartalis from the Bank of America Merrill Lynch, one of the best-known mining analysts in the country. Welcome today. Next, we have one of the best-known entrepreneurs in the mining sector, Tolga Kumova. Tolga is probably most widely known for his roles in founding Syra and New Centuries Inc. Today, we're also joined by Bryce Crocker and John Downie. Bryce is a director of Jervois Mining, first listed on the ASX in 1980. Bryce, so I looked that up today. But today the company is involved in an exciting cobalt play in Idaho, and I'm looking forward to talking about that with Bryce. John is the MD of Pure, which has an interesting ASX ticker of PM1. What's all that about, PM1? Can't you just stick with the letters there, John? Pure recently took delivery of a pre-feasibility study in something called the Townsville Energy Chemicals Hub, which sounds really good. And we'll be chatting with John on this interesting project, which is very much aimed at the future demand for alternative energy storage. But first, I have to confess, when in introducing Sophie, I worked with Sophie in stockbroking a few years ago, and I'm delighted she's taken the time this afternoon to speak with Minds and Money. Great to have you here.
Thank you. Thank you for the invitation. It's always great to be on these speakers, these little conferences. It's good.
That's fantastic. Well, you must have had a great time following the Australian companies as they've reached out into the rest of the world, and our gold producers in particular, they've been expanding globally. But what do you think the main drivers of that expansion have been?
Look, I think there's been two main drivers. The firstly is on valuations. Certainly last year we saw the TSX underperform the ASX quite significantly, and because here in Australia there was a thirst to grow, they couldn't look in their own backyard, and therefore they chased the value. I think the second driver is, when they looked to North America, it was a jurisdiction that they were comfortable with given how mature the mining laws were. But also they saw the opportunity on the production efficiency front. They could see that there was certainly scope for them to improve the mining methodology, get better equipment in there, renegotiate a lot of the supply agreements because they knew that they could get better costs here in Australia than what they were getting over there. So they saw those production efficiencies combined with the more attractive valuations, and that's what led them over there.
And I guess some of the big guys over there were sort of more in divestment mode, weren't they? Having just, put together a couple of mega mergers, bits were falling off, and there were some great opportunities. So if there's something to say about our industry, the Aussies, they're very fast movers.
Yeah, and I think that's, when we look at the management teams of our ASX-listed gold producers, they're very well respected, not only here domestically, but also around the world. And, this nimbleness really comes to play, whether it's looking at an M&A or even in the current environment, whereby they need to change what they're doing pretty rapidly and adapt to the changing environment. And this is when, I guess, good quality management comes to the fore.
Yeah, and I guess they're technically strong as well. You take a guy like Bill Beament, for example, very, very long history as a successful mining contractor. They took like a technology edge into these assets, some of which were a little bit unloved.
Yeah, no, absolutely. If you look at Bill, as you say, he's come from a mining contractor background, as does his whole management team, whereas a lot of the North American managements don't come from such a technical background, and certainly that gives them the edge when they're looking at different opportunities over there, whether it be from an exploration standpoint or whether it just be from, as I was saying earlier, the production efficiency standpoint. So, they believe that they can get in there very quickly, make an assessment of whether they think they can, add value. And then if they believe that they can, they go forward. So I agree, I think nimbleness, particularly in today's market, does pay off.
That's it. And we're talking about cash flow before. How important do you think it's been that weak Aussie dollar in generating those tremendous $8 returns that the Aussies have enjoyed?
Yeah, no, absolutely. We've had a very good run with $8 gold prices. We're now at, record prices. But I don't think you will see that go directly to the bottom line. I don't think you'll see 100% translation. If you look at costs, there's certainly upward pressure on costs, particularly as we're coming into, this quarterly reporting season and also into the June quarterly reporting season. We've got not only increased royalties given the higher $8 gold price, but also we've got pressures on the headcount front. So you're not getting these efficiencies that they generally would get coming into this fourth quarter. So I do believe that we're not going to see the cream on these production profiles that we're used to in the fourth quarter, and that'll put upward pressure on costs. So, yes, we're enjoying a very strong $8 gold price, but when we're looking at the margins, I think that they still will be under pressure.
That's looking behind us now. So we've dealt with that. That's fantastic. What do you think about the future there? How important do you think is exploration for these bigger companies these days, or are they leaving it to the smaller ones?
Look, we're increasingly seeing the big companies doing JVs with the smaller guys. We certainly saw that a couple of years ago. It's abated now, and that was really driven by investors really pushing for the companies to present a very deep pipeline of growth. So the quickest way to do that was to partner with these junior exploration companies. Oz Minerals, for example, is probably the champion at this, where they completely filled their pipeline and now they're working through those opportunities. I think now what you're seeing is, some of the bigger companies taking control of the exploration. If you look at Newcrest, for example, they've got their Red Chris recent acquisition in Canada. That's very much an exploration play that they're taking, on their own right. Also, they've got the Havieron project near Telfer, again, very much an exploration play that can potentially transform Telfer. So I think that partnership with the juniors really was probably at its max a couple of years ago, and it's sort of trending down now as these companies take hold. But, in terms of the exploration costs, you're looking anywhere between $25 and $50 an ounce. So still the Aussie guys are leaps and bounds ahead of their global peers when it comes to exploration.
Well, thank you for that. There's a few people on the audience today quite interested in that one. Look, that's fantastic, Sophie. Thanks for those opening remarks. And but before I go on to Tolga, Lucy's put together a poll for us today. And before we get to Tolga, we'd like to run that poll, and you can vote. There it is. Which metal has the best short to medium term appeal to traders and investors? And I know which way I'm going to be voting, and it looks like everyone's voting the same way too. That's something I like to see. Anyway, we got gold, we've got copper, and we've got nickel there. Okay, we'll have a look at those. We'll leave Lucy in control of that one and get back to that when Tolga's finished with me. Okay, and don't forget, Sophie. Later on, if you get a chance, don't leave us. Jump in if you've got any questions for our guests. Okay, well, Tolga. Thanks very much, Tolga. Great to have you on the webinar. Interesting markets we have at present. You work some magic as the world emerged from the GFC. How are you seeing the resource sector today?
How am I seeing it? Well, we went through the GFC, and it kind of reminds me of exactly the same experience I had once upon a time as a stockbroker, just like you, sitting on the desk watching these share prices go through the floor with no buys, and especially in the sector that I kind of work in, it's highly illiquid, and people are chasing, or redemptions are coming through, and the funds are chasing some kind of liquidity, and they're forcing all these prices down. And that forced selling is obviously creating more selling, and it's putting fear in the markets and fear in people. It's been incredibly difficult. Talk about what I've been doing. I've been trading Northern Star, and it's just because it's large enough to get liquidity in it. Usually it's not what I do, and the reason why I've been doing that is knowing there's redemptions are coming through, and some of these valuations down at $9. It really didn't make much sense considering where it was, a couple of weeks before. There's been things like that. A couple of tiny placements I've been involved in, kind of keeping companies alive, but it's been like, it literally just feels exactly the same as the GFC, except the one part we don't know is how long this goes for. And the other part that's actually kind of, say, scary for fund managers, or difficult for fund managers, is that it's happened so quick. Usually, the GFC, it was kind of, you saw it coming, and it went over a long period. You had 6-9 months of it. This happened in 1 month. So yeah. Fund managers really haven't had a chance to be able to plan for it, adjust for it, just being reactive. And again, come back to the same point. When you see forced selling, it's kind of scary for fund managers. Having said that, it also presents opportunity. So there's this saying that I love. It's called "The tide goes out, all the ships go with it," and only the ships that are worthy come back. And that's what you've literally got to look for, and companies need to be invested in.
That's mate.
Exactly.
That sounds, yeah.
One of the companies I'm associated with, Baillieu, was like gold play deposit, beautiful deposit, Western Australia, great management team, beautiful asset. Stock was, I don't know, $300-400 million valuation. Within a month, it's fallen to 29 cents. and the deposit hasn't changed. The market in the world has. But I know of 2 funds that were forced redemption sellers in the stock, selling through price points just because they had to get liquidity. What happens? You know, the asset hasn't changed. It is spectacular. The management team is fantastic. They go and raise almost $30 million with BlackRock, best investor in the world. And the stock's back at 55, 60 cents within 4 days. So time goes out, the good ones will come back.
That's what I was going to lead on to the next thing I was going to ask you is how easy is it for people, you know, with good track records and good projects, how easy is it for them to get backing these days? Is it, has everyone gone to water or?
When the assets, well, that was a unique sort of situation. I mean, it's a tier 1 asset, and usually that's what you want to be invested in, especially if you're in illiquid stocks or closer to being illiquid. Anything that looks tier 1. It's for them, when the opportunity arises, and raising capital, I suspect, in this market, now might be a little bit easier. A couple of weeks ago, it was almost virtually impossible. You know, I was having guys come to me, well, discounted rights issues, all sorts of things, which would have destroyed a couple of, you know, basically the share structure in a couple of companies. But the companies, the businesses that have incredible assets, incredible management, they can come back. But you gotta remember one thing about our market and our industry, it's cyclical. So incredibly cyclical. So going back to the GFC, the amount of money made coming out of it for those that took the risk to be in or stay in the market without going through the fear, without going through that panic, yeah, they all kind of came back. Majority of companies, and a lot of amazing companies grew as a result of it. They're taking advantage of the opportunities. So, I mean, perfect example, I'll give you an example. Like talking about cyclical and you're talking about commodities. Was Andrew Forrest. We'll talk about Fortescue. You know, it's flying high once upon a time, just before the GFC, it was $10 and going. Comes along, world falls apart, stock's like $1.50. And I still remember it being $1.50 because I had a client who had a margin call and I was a stockbroker, thinking, I don't want to sell this. I want to do anything but sell this. What can I do? Look at it now, you know, world turns around, it's still $11. I wish could I hold for the clients, you know, 1,000% return, but what's we going to do?
That's it. And I need to reiterate that none of what people hear today should be construed as advice. This is informal forum, and we will make some forward-looking ideas, put them forward, but get your own advice. Do not take this as advice. Got the health warning out of the way there, Tolga. Now, here's one for you. Africa. Now, you know, you did quite okay. What are you seeing? Is anything interesting coming out of Africa? The Chinese got it all. What would you say?
I'm not worried about Africa as a jurisdiction. I mean, you go where the tier 1 assets are, and assets that you know are going to generate income actually are going to be fundable, you know, in the right environment. So it doesn't matter if it's Africa or anywhere else in the world, if it's South America, just pick any country you want. If the asset's tier 1, then you can always find a solution dealing with these governments and the local people, as long as you've got the right attitude towards it. I mean, what am I looking at? I've got a major investment in a little company called Canyon, you know, tier 1 bauxite asset. The management team is growing and it's being more stable. And that's one that I'm incredibly keen on. And at some point, I suspect it'll just get taken out by a Chinese group that's chasing high quality, high purity bauxite. I'm actually invested in, well, I'm director of a company called African Gold, which has been looking for gold, but it's, you know, again, exploration. So I'll qualify that, high risk, high reward. I'm also invested in Bryce's company, who's coming up. I don't know if I'm a top 5 to a top 10, probably top 10 shareholder in there. You know, I've been there with Bryce for ages, and I do believe in his asset. But they're drilling in Uganda for gold. So, I mean, if I get lucky there, it's great again. But yeah, in terms of jurisdictions, it's just basically tier 1 assets that I'm looking for or exploring for. I was funded a project in Brazil recently, looking for what looked like a giant deposit. You know, made all the representations, all the rest of it, which didn't turn out to be what it looked like it could have. And it's again, it's painful, but it's exploration.
That's great, mate. And you're great at the way you back things and put your heart and soul in. And thank you. Thanks for coming on there. Now, if anyone's got a question, don't forget there's that button there that you can put your hand up. But we'll look back at the poll here. We're, as no surprise to anyone here, I don't think gold won the gold medal. There with a 74% of people thinking that that was the medal with the best short to medium term appeal. I must have got my vote as well. But we've got another poll coming up there, Lucy, where we're trying to get back to this future of the industry and where we think the best way to achieve growth. Is that coming up there somewhere, Lucy? The poll. There we go. Which method is the best way to grow a mining company these days? M&A or exploration? Well, I can see a few explorationists in the screen in front of me, so I think I know where that the tide will turn on that, which is a great segue into Bryce Crocker. Bryce, thank you very much for joining us today. Jervois has some experienced people on the board, and they all seem quite excited about what the company is putting together. Can you tell us a bit about what you're doing and your major project, and maybe even a bit more about the Ugandan experience you're having?
Tolga did make a reference to the tide going out and the ships that come back. Investors will be more selective. And I do think that's right. Obviously, we've had 2 years of, it's not just COVID, the last 2 years has been dire for anyone who's been investing on the battery front. So I think it was clearly the market ran too hard and fast in late 2017. And I guess what we're focused on, I mean, I fundamentally believe the macro will recover, but COVID is obviously a significant headwind near term on the electric vehicle side. But the macro will come back, and when it does, I think the quality of assets and also the teams that are in place to deliver them, which is where I'm fortunate in terms of the support that I've got at the board and the management level that you don't get typically at this end of the market, when we're comfortable with how we're positioning ourselves. So we've purchased a part constructed mine in Idaho last year. There's $100 US that's been sunk into the ground. We've got to finish a mine that's essentially partway constructed. Current timeline is we'll be in production Q4 2021 with the only cobalt mine in the United States. Cobalt's obviously, it's a critical material. It's been listed as such by the Department of the Interior in the US. Significant concern around China, significant concern obviously around the DRC, where 3/4 of cobalt comes from. And so the ability to bring on something that's small, but you know what, we like small, simple, technically simple projects, particularly at this end of the market. And the ability to bring it on quickly at a time when there is a strong need to get units from jurisdictions which are more reliable. I think that's really where Idaho comes in. So we're updating a BFS. A little ironic that you're doing a bankable feasibility study when there's $100 US in the ground, but therein lay the opportunity to acquire the asset mid last year. And we're in the short strokes on the BFS now, and we're talking around with lenders about what we're going to do there. We sent an IM out to senior lender providers, a selected pool in December. Got the indicatives back. The bankers are in the data room with the NDA, and we'll ask them to sharpen their pencils, and we'll make a decision about who we move forwards with on the debt side. And obviously, in the current environment in the US, I mean, as I said, cobalt's always been a concern for the United States government, for the United States industry. But now you're in a situation where COVID is obviously having a profound impact on the US economy. Unemployment is going to be a significant and rising concern in coming months. And so whilst we still have those kind of commodity specific attributes that are still there, you've also got a strong desire within the US in the second half of this year and into 2021, anything you can do to create jobs, buy capital goods. 80% of the capital goods that we purchase will be US constructed. Anything you can do as the US attempts to kind of re-establish its economy is obviously very, very important. So we're excited. We're well placed. Clearly, this is it's the black swan of black swans. And I think just touching on Africa, I mean, when I sit in and I'm talking to McKinsey and BCG and they're going through what's happening in the world, there's 20 countries, and you know what? Other than South Africa, there's nothing on Africa. But the ability of countries, I mean, we operate in Uganda, so we've got a front-line view there. But I think that's really where the impact of COVID is kind of less understood, where the potential impact is potentially much greater than what it is in the West. Somewhere like the DRC, for example, where 3/4 of cobalt comes from, you've got 20% of the workforce already has HIV. Their immune system's compromised to begin with. You have no health system of note. And certainly you're starting to see that in the DRC with a large number of mines shut. The border with Zambia is shut. The port of Durban, where the cobalt leaves for China, is shut. And so I don't think anyone who pretends that they know how this is going to play out from a demand side, other than it's going to be fundamentally bad for demand. I mean, that's...
Yeah. Hey, Bryce, I had the good fortune of catching up with your chairman at the Melbourne Mining Club there, and he was very excited about the way you managed to acquire this project. Can you give us a bit of the colour around how you came by the project and how it's come about in your portfolio?
I mean, I guess we identified it when we came into Jervois late 2017. I approached the previous CEO essentially the next day. There were two approaches we put in. One was on Kabanga to the previous owners, and the other was this asset. We identified assets we really wanted in the portfolio if we're going to actually create a producing company. This is a small deposit, kind of a 5 million tonne resource. So it's not of the scale of the great deposits in the DRC that we're associated with previous employers, which are 50, 150. But it's high grade, similar sort of grades to the DRC. Relatively low technical risk. It's small. Biggest challenge is it's small, but producing with the scale that we're looking to produce will probably be around 20% of US cobalt demand. And the United States, when I used to sell and work alongside traders who delivered material in there, it is, I think, the most strategic cobalt market in the world, just given the importance of aerospace defence, particularly going into superalloy production such as jet engines, rockets, missiles, etc. So it's a great jurisdiction to be. I mean, Africa is somewhere where we're comfortable operating, but I think the reality is that if you look at the DRC is, I think, inoperable from a Western governance perspective. A lot of your investors form the same view. And I think what this asset does is it gets us into production, gets us in generating US dollar cash flows in the US, and it's just a great opportunity to create to get it into a public vehicle and create an operating company based around that.
Well, I see your market cap's $90 million there, so it does look like an opportunity. I'll just check with Lucy there. Any questions coming here for Bryce just at the moment? Nothing there. That's all right. You've slayed them. And how's our vote going there? Polling. Oh, neck and neck. 56% of voters think that M&A is the best way. Obviously, the assets are looking cheap in the market there. Oh, that's great. Well, Bryce, look, hang on there. We might come back to you a little bit later. But thank you very much for your comments there, and also we look forward to seeing and hearing from yourself and Jervois at the Melbourne Mining Club, maybe at the cutting edge when we're allowed outside our front doors once again and into something bigger than a phone booth. So thanks very much.
Thank you, Richard.
Well, look, this brings me now to Pure Minerals, where John Downie is the Managing Director. John, can you tell us a little bit about your background? And then I want to hear a little bit more about this Townsville project.
Good. Well, look, thanks for the opportunity to speak. I guess our story is pretty consistent with what we've heard to date. You know, we're a small company, just recently listed back in May, and we've got a project in Townsville. So we're reliant on the battery sector. I guess you know, I'm pretty positive. I think that things haven't hit their straps as quickly as people would have expected, and I think the incentive programs to build more electric cars sort of fell off sooner than people predicted. So that hasn't been so good. But at our stage, we've still got a 2-year horizon, completion of bankable feasibility and finally sort of getting up running. So, having a 2-year horizon is not a bad thing. I guess it's a pretty interesting project. We the 3 complementary products we're looking to produce are nickel sulfate, cobalt sulfate, and a high purity alumina, and all those come out of our high quality ore supply out of New Caledonia. We also produce a number of co-products, but pretty well everything that's in laterite we're able to extract and turn into a primary product, a high value product, or alternatively just a co-product that we'll sell and generate some small revenue.
Can you walk us through the technology there, John?
Yeah, well, look, what we have we got a slide up there, Lucy?
Well, there we go. Yeah. Well, fingers crossed, everyone.
Oh, here we go.
It's a bit better behaved than last week.
I guess the little picture up on the left-hand side there is a snapshot. So mining in New Caledonia, we have a processing plant using ostensibly the direct nickel technology. It's a nitric acid leach at atmospheric pressure, and the significance of it is that it's very green. We're able to extract all the metals, as I mentioned before, so we end up with a very smaller volume of tailings, and the tailings haven't got any acid that has to be neutralised, and of course they haven't got any metals left that will leach into the groundwater. So we think that's a good choice. But what's attached to the back end of the plant is 2 refinery circuits. One is taking the MHP, or the nickel cobalt concentrate from the process plant, refining it and producing a high purity nickel sulfate hexahydrate, cobalt sulfate heptahydrate.
Have you got much support from end users just at the moment? I mean, I know it's early doors there here, John, but this would seem to be an important product in the whole battery scheme of things.
Yeah, well, certainly the cathode active materials and also the HPA are pretty important pieces of the puzzle for building batteries. We're fairly early stage discussion, both in Korea and Japan. We've sort of set our sights on those 2 locations, as there's a number of major battery producers, and we believe that there's already some understanding with how Australian companies operate. So and we're getting some positive positive responses. We haven't signed up any long-term supply options, and I don't think that's not going to happen until such time as we've completed our pilot plant run.
No, absolutely. But the feedback from them, I mean, we touched on it earlier about the end demand for going into that electric vehicle market. I mean, I don't see that going away. But it's understandable if, as you mentioned there, that the love affair is sort of cooled off for just the moment. Is that one way of describing it?
Yeah, it's probably cooled off, and certainly the current situation we find the world in has accelerated that. But coming out of that, the need for reassessing supply chains, I think, is going to make quite a difference to what happens to particularly the producers of the precursors for battery manufacturing. But also, if you look at like a lot of the major issues now are central to high density centres, and that's really where the electric vehicles will shine, and we should be able to see significant reductions in the contamination in the air, particulate, those sorts of things, and it's early days to predict, but clean air should provide a better environment for flattening the curve, if you like.
Now, if I could get you to sort of look into the future there, you're a $7 million market cap company, and this is a multi-million dollar investment. Where do you think that the funding for this will come? I mean, share market, it's tough. Debt, you need that equity contribution in there, but private equity, that's a group that was making a lot of noise, before everything fell apart. Can you give us an idea? I mean, it's really early days, but just on the potential to fund this thing.
Yeah, well, look, 7 million today, but our market cap was a bit higher than that a few weeks ago. But it's a big call. The total capex of that picture I just presented there is about 650 million, including contingency. So it's 650 million Aussie. So it's quite a bite. And I don't think there's any one solution. There's offtake partners that are still very interested in backward integrating, and you see that deal with BlackRock. Not BlackRock.
Yes.
Last week. Anyhow, I'll keep going.
No, that's okay. Actually, I might. Tolga's a bloke who's taken a $7 million company to fund a few $100 million plant. Mate, is there any advice you could give to John at this stage?
Honestly, timing is everything when it comes to markets, and especially when you're trying to build a business. I've been listening to you guys talk about electric vehicles and it's going to come and all the rest of it. I'll probably add this. There was a big run up in all electric vehicle demand and basically investor interest back in 2016, 2017. And it kind of is sort of stagnated a little bit, but it's not really stagnated. I mean, all the work is happening in the background. All those big car companies are doing all the retooling, the battery plants, putting all that engineering in place, putting all education in place, and effectively getting people in the broader community used to the fact that electric vehicles will be here. So we're all kind of accepting it's coming. Kind of reminds me of back when the dot-com boom happened. You had this massive run, 98, 99, into 2000, and then all of a sudden everyone's like, computers are going to be amazing, it's going to technology going to control the world. That was great, and the share price on these things that basically had nothing at the time, gone through the roof in massive valuations, but kind of repriced itself, fell away, everyone lost interest, but the people working behind the scenes in that technology, 7 years later, you've got Google, you've got Facebook, you've got Apple, all these things have just developed their products and came back to the market. So, and it did occur. So we have this massive technology boom that's controlling the world. Same thing will happen with EVs. Same thing will happen with cobalt, the demand for lithium and for graphite. It's going to come. It's just a matter of time. And once it does, you want to be ready. You want to be set. So I don't know if he's going to raise $600 million in the next 3 months, 6 months, 12 months, a couple of years. But when the time comes, there will be so much demand for these minerals that he will be able to.
That's very, very good. I can see John's got a bit of a smile about that. That's a very good thing. Can I
Richard, can I jump in?
Sure.
It's Mike. We've had a couple of questions. One from someone you know very well, Gavin Collery, and also Headley. So maybe if we could start with Gavin, that would be
Gav,
great, and then you can direct the answer.
And then I want to ask Sophie a question. So keep going, Gav. Let's go.
Okay, thanks, Richard. I popped it up there. I was looking at this issue of the kerfuffle around COVID-19 and dividends. There's been some controversy there about the payment of dividends. Now, I know that we're talking mining, small and mid caps, but I was interested on the view of the panel, particularly on whether we should be paying dividends at this time, and this whole issue. Is it really a non-issue, or is it something that we have to consider? Given Brian Phillips' classic line, of course, that never been a director or the chairman that paid it dividend. But we'll see what perhaps Tolga and your other panelists have to say.
Right, I could hardly hear your question. It was really muffled.
Yeah.
Gavin?
That's
COVID
no.
and dividends.
Dividends. Geez, you are a forward looker, Gav. That's let's. Yeah,
you sound a bit like a retiree, Gavin. Where's my dividends?
No.
He looks like one too. Headley, hey, so we might even take that from you, Gavin, as a comment, not a question. Headley, you had a question. Yeah.
Sorry, you've thrown me there. Question for any of the market commentators. Rich, I'd count you amongst that. Tolga, Sophie, perhaps as well. We've seen a collapse in the market. I don't know if you want to call it a crash or a bear market or whatever. Some people think it's over. Some people think we're rallying back now, and I don't know what the answer is to that. But usually, when you see equity prices run out, liquidity fails as well, and people wanting to build projects often struggle through that period. We've seen a Red 5 raising for a massive, a very substantial expansion. We've seen the Baillieu raising that Tolga you referred to before. Strikes me that gold is an interesting place at the moment because there seems to be liquidity there perched and being delivered. Is this a market where investors are going to be prepared to take risks to build gold projects despite whatever risk is forcing them out of the market? So, Rich, that's my first question.
Can I throw that one to Sophie then, Headley, then I'll get your second one?
You can, but my second one's really quick, and it's Tolga, it looks like you've been sort of raising a glass of what might be mixed berry Big M to your lips. Can you clear that up for us before we get onto the gold one?
We might take that offline, I think, Headley. Sophie, that story about the you had a question about the gold and gold plants.
Yeah, look, I think I can answer both those questions in terms of the capex requirements for the greenfield plants and then also the dividends, because I've just got off another call actually where this was first and foremost the biggest topic. So in terms of gold projects, look, I think it's going to be really tough unless it's a tier 1 asset where you've got very Q1, Q2 costs. I think it's going to be still very hard to attract institutional money. I speak to investors from all around the world, and even on the gold front, even though we've got gold prices, we are very structurally bullish at Bank of America on gold. They are still gravitating to those large cap gold producers, Newcrest, Northern Star, Evolution, and maybe even Saracen. So, I think if smaller companies are wanting to come to the market, what we've seen is a real polarization between, particularly in the gold sector, of the big companies who perform well, they're very well known, the management is very well known, versus, the small new up and comers. I just don't know if today is the market will support those kind of projects. And then I might just answer the second question on dividends.
Yes.
It's interesting. We are finding that in the consumer space, we're getting a lot of feedback that dividends is not a social thing to do right now. So they're really leading on this ESG philosophy. They're saying if we're laying off a lot of our people, really should we be paying dividends to our shareholders? And so I think what we will see across the market, not just resources, is companies hold back or defer dividends in this upcoming reporting season because they don't want to look like they're rewarding their shareholders when they've put all their stuff out on the street. And then
that's a very interesting observation there, Sophie. Can I ask you, I was going to take you over the battery side of things. Over the last 6 months, we've had maybe some of the bigger companies maybe flirting with the idea of getting involved in the battery metals sector. Do you think that's a likelihood, or in the future, are they going to stick to their knitting?
I think they'll stick to their knitting. I think IGO is the company that springs to mind here. They were certainly flirting with that downstream processing plan. I think that was really at the end of the day a negotiating tactic for their upcoming nickel sulfide contracts with BHP and Glencore. So I think that, they've done sufficient work, but I think from an investor perspective, people would prefer the miners sticking to their knitting and just mining the material and letting, the other people in the supply chain sort of look at those sulfate type products.
That's a very interesting comment. Thank you very much for that. Listen, we're getting up to 5:45. Have I got more time here there, Shireen?
Richard, we got a question. Hold on, Shareen. Yeah, we got a question from one of the fund managers here. Will there be, and I'm paraphrasing a little bit, will there be a rush to market as there was in late 2009 and 2014 and 15 for juniors raising money now, willing to give away a bit to take their knocks to potentially raise money when the market will get harder? So
Yeah, I think we're starting to see that at the moment too. But I guess people raise money when they need it, and then the good ones go out there and spend it, and then have to come back and raise money again. It's taken De Grey, for example. I mean, they've gone out, they've raised money, they've put it in the ground, they've got the result, and probably over the next 6 months they'll have to come back again, and we'll be very keen to write the check out again because they did so well with the last lot of money we gave them. I think that's the answer to the question is, and maybe Headley, I might actually get a comment from you on this. If you're funding these type of vehicles and they do what they said they're going to do, what more can you ask?
Well, I think that's a pretty valid comment, Richard. Yeah, and I wonder, just in addition, in response to that question, the GFC still seems quite close in people's memories. And particularly the junior companies which had subsequently struggled through 2011 through 15, and they might be worrying about how long a downturn might be if there is one. So, raise now and make sure you've got the money. And then if you spend that wisely, come back and you might be rewarded again. But it pretty quickly sorts out, pardon the expression, the men from the boys as to who will get the money in the next round around. But I reckon Tolga might. I mean, yeah,
I was going to ask Tolga. Tolga, you've been on both sides.
Who can sort of really spot opportunities where money's going to be spent well and generate value in the market quickly. I'd be interested in your response there too, Tolga, to that question.
Yeah, Tolga, if you could.
I've been through this process. You raise money when you can and when you need it, especially when you're a junior money company. I hate to say it, you always need money. Whether you first raise it, you need more after it. That's just a thing. That's just how it works. But if the management team, and I know, like I said, I invest in all sorts of interesting things and players and exploration and development, all sorts of stuff. But if the management says they're going to do something and they make a representation and you make an investment on that basis, and they actually go and get the numbers, get the results, they can't plan. You can't blame them for the world having COVID-19 or a GFC or collateral issues or whatever. You can't blame them for that. Whatever the share price is, it is what it is. But as long as they go and deliver, and what they're delivering is of actual value, not something that's a great technical result, great geological result, fantastic. They're actually going to be able to produce some kind of return in the future, then you give them money as an investor. From the other side, well, you've got to be very clear with what representations you make. And it's happened to me where people have made representations and not been as forthcoming as they could have been, should have been. I've learned the hard way as well, don't get me wrong. Then they're going to have issues coming back again. So they get their one chance and their one time. But as long as they do what they say they're going to do, you'll be there for them.
Well, a very old corporate stockbroker said to me a long time ago, when do you raise money? Exactly what you said, Tolga, is you raise it when you can. And the market will always provide capital for good projects and good people. So the couple of truisms from the Book of Morrow. Well, let's call that. Now we're coming. How are we going for time there, guys? Are we got time for one more question at all? Shireen, how are we doing?
Look, I mean, it doesn't look like anyone has any other questions or comments. Obviously, we did the polls. I was hoping that there might be some commentary around the M&A question. I know that Andrew Woodmore is there from the M&A side, as are a number of the other financiers. I wondered whether Bryce or John, did you have any further comments about your projects or any updates, any tours around the road, obviously the virtual road that you might be doing?
Well, Bryce, we'll throw to you first there. First of all, how do you manage with such diverse geographically a suite of projects?
I think I averaged 1 week at home, 1 week a month at home last year. So 2020 is going to be a little different for obvious reasons.
The dog doesn't bite you when you come home, is that what you're saying?
It's clearly, I mean, it's, 2020 is a profoundly different year to what it's played out to be. It's game changing, and I think just in terms of the question, in terms of equity, I think the key at this end of the market, never raise money to keep the lights on or to pay your salaries. That's the ultimate key. You're only doing it for a reason, and you're thinking around what's the reason that I need to do this. Because at the end of the day, raising money at these type of valuations for anyone who's involved in the mining sector, you have to be pretty confident that you're doing it right now for the right reason. You've got visibility about what that cash is going to be used for in coming months. And I think there is people are really talking about scenarios. No one really has a forecast right now in terms of what comes out at the back end. This is going to be kind of game changing for everyone, consumer behaviour. But I do think it's different from the GFC. And I disagree with, I think there was a comment earlier that the GFC, I think you had less visibility in the GFC, because here you've got banks that are well capitalised. You've got governments that are lined up and just throwing the response that we've had, like $10 trillion within the first 2 or 3 weeks. It took governments months to ideologically get their heads around that they had to intervene in markets last time, and it took the failure of the bank in Lehman to kind of push them into action. This time you've got governments that are actually stepping up and actively, very aggressively playing a role. The banking system was well capitalised. There's no liquidity constraint. I mean, even with all the drawdown notices that the commercial banks are getting, obviously the Fed's just pumping liquidity into the system. So it's not, I think there is light at the end of the tunnel. The question is how the tunnel is going to look and what we should do as a business. But as far as, if anyone in this market, it's all about cutting costs aggressively, and as pronounced, it's an opportunity to kind of reassess where you are as an organisation, and really, as I think it is going to differentiate investments on the other side. They are going to be heavily differentiated in terms of the quality of the underlying asset and your ability to deliver, because investors can be selective. Particularly at this end of the market, you can invest in the big caps and you can make 20, 30, 50% return. So why would I invest in a junior? So I think investors are going to be much more selective at this end of the market. Obviously we're sub 100 mil, so it's the kind of area I'm focused on now. Very selective about who they back at this end. I think it's important.
Thanks, Bryce. And John, any sort of parting sort of thoughts and key bits that you've picked up from the conversation this afternoon?
Well, look, there were some great comments there. Can I just say, I haven't put in a plug for our pre-feasibility study. We're talking about a pretty significant announcement we put out a week ago, and reflecting a spot case or spot price of nickel of 570, and maybe even that's a little bit high currently with where it's at, but we're generating a post-tax NPV and IRR of 1.1 billion, right? So and about a 25% internal rate of return. So it's at really quite low end of the commodity cycle, where we've actually got a project that shows some pretty spectacular returns. So
that's right. And when you've got a bond yield paying less than 1%, money should be attracted to that, but it's got to come from somewhere, hasn't it? I'm just wondering about the source of capital, and that might be a good subject for our next webinar. I think, Shireen, I think that could be something we could all look at. Well, on that note, I think it's time to. What do you think, Shireen? Shall we wind it up? Look.
Yes. Yep.
Thank you so much.
We've got one question, Richard, actually.
Go right ahead.
From Grant Farman. Please ask Scott Williamson about the BSX deal this week.
Scott,
yeah?
You're unmuted, so if you'd like to answer that question about from DH Flinders.
I see you down there.
Thanks for the opportunity, guys, and great format and great conversation. Yeah, so we did the deal this week with EcoPro. EcoPro is the largest cathode manufacturer in Korea. They've put $6.8 million in at a 62% premium to market. So yeah, we're in a pretty strong position. I suppose very lucky that we don't have to access capital from the, conventional markets. And I think it shows that there are funding partners out there ready to invest at the bottom of the market and that are looking at long-term, future of the industry. So yeah, we're we're in a very strong position at Blackstone, and yeah, we're very happy with this week's deal. So yeah, thanks for the opportunity, guys.
No, that's great, and maybe we can hear from Scott at a webinar in this wonderful series. Look, then it's up to me to thank everyone today. I really want to thank Sophie Spartalis for joining us. Of course, the Bank of America, Merrill Lynch, been great supporters of the resource industry over so many years in this country. So thank you very much, Sophie, for making yourself available. Thank you, Tolga. You're a great mate. You always support Melbourne Mining Club, and you always support Mines and Money. That's fantastic. Bryce, that sounds like you've got a lot of work in front of you, but it'll be great work and be a great project at the end of it. So thank you very much for making yourself available. And of course, last but not least, John, thank you very much for coming on today and walking us through. And I personally want to see a bit more about that PFS document that you've got there. Thank you to the Mines and Money team. You guys have been fantastic. Thank you so much. And let's do it all again next week.
Just before we sign off, Richard, I'd like to say thank you to you and all the participants as well. You've done a great job this week hosting the event. It was a thoroughly good session. So thank you to yourself for hosting it, and also all the participants as well.
Fantastic. Good on you. Travel safely. Have a great Easter. Thank you.
Thanks, Richard.
Thank you.
Yeah.